Managing risks, recognizing, understanding, and mitigating the risks in crossing the crypto road. Moderating the panel is one of our favorites, the chief interrogating officer that really knows his stuff. David Wachsman has been in the industry, and his firm has advised, just if you look at some of the most important projects that we all know, if I was ever launching an important project, he would be definitely one of the people I'd need to speak to. And he's recently committed actually to the Swiss market, opening an office in Geneva, so he's a lot more accessible. Please welcome David Wachsman to the stage.
Hi, everybody. So as you may know, in 2022, we had a pretty tough year. In May, we saw an epic meltdown of Terra Luna. We saw 3 Hours Capital. We saw eventual bankruptcies from almost all of the consumer lenders in Bitcoin. And of course, this was nothing, paled in comparison to the FTX meltdown that took place in November. So joining me on stage right now are 3 of the world experts on managing risk, which I would say is the single most important topic in crypto today. So let's get straight into it. The way I look at it, there are basically 2 types of risks that I think that people need to be concerned about. I'm gonna call them market risks and technical risks. And on this panel today, we've got about 40 minutes. I want to talk a lot about both. Each of you has your own extraordinary perspectives on this. But first I want to talk about some of the, well, let's talk about the elephants in the room, the black swans. Marcos, tell us, what do you think are the possible things that could come next? Well, we're going to get into how we might mitigate that, but let's be honest. I mean, the contagion probably hasn't ended.
Yeah, that's a punchy question to start, I would say. I mean, after what happened in 2022, I think, Taleb says that about black swans, is whatever is there that we have got used to seeing things in a certain way, and this will surprise us, and we are not expecting it. I think, so for 2022, I hope there are actually no black swans. I think we are expecting certain things that may or not may happen, but I think the market is kind of getting ready for it in certain way.
You think we're getting ready for more black swans, you're saying?
More like, market shaking events. Like, for example, more like a black swan, I would say, will be at this point one of the main stablecoins provider to disappear, or what happens if you lose.
All right, let's talk about that. So there's a real risk here that one of the major stablecoins, which house or warehouse billions and billions of dollars, and are very much the kind of cash out for trading.
Exactly.
That's a possibility. Okay, another black swan. Philippe.
For 2023.
What's a possible black swan that may occur?
I mean, there's crypto is all about black swans, right? So when you think about risk, it's fine to think about what may happen tomorrow and the next day in the markets. But the people who have done this for a long time, every year you see 1 or 2 black swans that just come out of the blue, completely.
By the way, I've got to say, it scares the daylights out of me to say that crypto is all about black swans.
You'll see some in 2023. They happen less in bull markets, and I'm hoping we're slowly getting back into a cycle where we're going to be trending up again. So in bear markets, people get exposed for what they're, for all the wrongdoings that they've been doing, right? In FTX and in Madoff, a crisis showed that they were not doing the right thing, whether because of fraud or because of operational mismanagement. So it's very hard to pinpoint exactly what kind of black swan we could see in 2023. I think right now we're in a good position, actually, because a lot of the black swans have been kind of eradicated because there's no risk in the system. There's a lot of deleveraging that's happened, and probably more to happen, especially in the secondaries. I think Bitcoin and Ethereum, they got sold first because they're liquid, and that's what people sell first, right, in their portfolio. But I think first quarter, first half 2023, we'll see some stories. We know those, who they are. They're kind of front and center these days. It's hard to know really what will happen to them.
So do you think there's a possibility of additional large corporate bankruptcies that may, I don't know, disentangle a lot of digital assets and flood the market?
Yes, it may not impact the crypto markets as much, but it certainly will raise our eyebrows.
Okay.
Right?
Ambre, what do you think?
I was going to say that I was going to be slightly on the positive side also, thinking a lot of the really nasty things we've seen in 2022 is probably a big part of what was awaiting. There are a couple that are already in the pipe, without naming them necessarily. But otherwise, I think we're going to still see some cascading kind of collateral damage of all these major failures take place this year. But I also am quite positive on the fact that most of the things have been weeded out by now or priced in, and that the effect on crypto markets is going to be more subtle.
Okay, well, I am reassured by that, that this, at the very least, has been priced in, the possibility of some of these, I'm going to call them more obvious black swan events. Okay, so let's go into defining risks. I think that's a very fair point. Philippe, you and I have spoken extensively about this. What would you say are risks that are inherent in blockchain and crypto markets that do not exist in traditional finance?
Yeah, there's some crypto native risks that people who are in TradFi are not usually accustomed to seeing. Obviously, everything that surrounds a blockchain is a risk. You're transacting primarily on a blockchain. Even if you're trading on a centralized exchange, you're exposed to a Bitcoin fork, for example. Those happened in the past.
And so let's just go dig into this for a moment. Let's say a Bitcoin fork happens. What does that mean? Does that mean that if I, as an investor trading on an exchange, am I going to see a depreciation in price of my digital asset?
The problem is you don't know, because the fork can be a completely benign thing where 90% plus of the network is okay with it, so it forks perfectly. Every exchange knows what to do, every node operator knows what to do, and everyone's kind of on the same page. We saw it with Ethereum from a proof of work to a proof of stake, right? That was effectively a fork. In Bitcoin, though, on the last fork, with SegWit, there was this war, and we didn't know what was going to happen. And Bitcoin was extremely volatile, and the exchanges didn't know what to do. So you had the levered exchanges that had borrowed, Bitcoin. Did they owe both forks? Did they owe just one fork?
I mean, this is
it
wild.
was, everyone's kind of looking at each other. Hey, what do we do? It's a huge risk especially when you're a custodian. Which fork do you choose? And we saw it was BCH, we saw it was BSV, Bitcoin Satoshi Vision, Bitcoin Cash, for those who don't know, and Bitcoin, the Bitcoin that we know today.
All right, so this is just even one. But the point is there's others that are kind of inherent in crypto. Marcos, what would you say is another one that only exists in crypto? And I think it's important for us to define these things because as an investor, if I were trying to determine whether or not I should be buying, selling, in some way participating in this industry, you need to know what risks are simply there.
Yeah, I think as a custodian, of course, I'm going to go to the basic one, which is the management of the keys, right? So I think we have seen quite an evolution in the last 10 years from software wallets.
They're effectively bearer bonds in essence.
Exactly. Whoever holds the key is the owner of the assets and has the power of disposal. So you as a fund, especially that we deal with institutional investors, so anyone that has a fiduciary duty, you want to manage that risk very well, because you know that the moment that you make a transaction on the blockchain, that's irreversible. So you cannot make a SWIFT and just call back or call to the other bank and say, hey, sorry, we made a mistake. We sent you just $100 million. Will you be so kind to send it back? Otherwise, we're going to go to the press and push on the legal side, right? When you do it on the blockchain, it's like, unless, of course, the other counterparties, maybe, I don't know, you were lucky.
So this is why people, just to kind of cut this off, I would say that people can whitelist wallet addresses, perhaps, if they're working with a technically proficient custodian. Is that correct? So this way you can not accidentally send your coins into the void.
You could, but I mean, not everyone is that, let's say, sophisticated.
Yeah.
So you need to get to that. It's a real risk.
Because it's the equivalent of literally lighting a stack of cash on fire.
Yeah.
It's possible. Okay. What's another technical risk that exists only with crypto?
Smart contract risk. I mean, one of the big...
Can you define that a little bit?
Code, errors in code and vulnerabilities that can be exploited by hackers that have nothing to do with the fact that the blockchain works or doesn't work, but just the code was wrong, or there was a vulnerability in the code. And so I think that's an obvious risk is, as soon as you get applications and use cases for any given blockchain, if you have a large protocol that gives a lot of value to that chain, and then there's a massive hack that is just purely a code problem, that just obviously has impact on the actual token of that blockchain.
Fair enough, especially anything related to DeFi, which is essentially smart contracts that kind of link to other smart contracts in a row. And if any one of them has a bug, money can be lost, substantial value can be lost.
Yeah, and it's not the fault of the actual layer 1 token, but it still impacts just from a reputational standpoint because it's inherently tied to it.
I also want to ask you about tokenomics, or market depth, perhaps, is a better way of putting it. We saw with FTX that they had, as a large part of their balance sheet, FTT tokens, which were their own exchange tokens, and then Serum tokens, which were essentially tokens that were meant to power a decentralized exchange called Aura DEX. Why were the balance sheet numbers wrong?
So I didn't answer that to your first question because I thought that's maybe not specific to crypto, but it's very interesting because this is a traditional risk that for some reason within the crypto space is not perceived properly. And that goes with counterparty risk and liquidity risk, in my opinion. Those are two things completely misunderstood in crypto, probably not by that kind of crowd, but by the kind of mainstream crypto. Counterparty risk is one big thing, right? And it's about who do you trust with your funds. That's number one. And the second one is liquidity risk. Understanding that market cap is an awful metric for understanding a token's worth, right? What is important is inherent liquidity, is organic liquidity, as in what is actually happening on exchanges, and not
Can you just define some of these terms? What is organic liquidity?
So organic liquidity I would define as the sum of daily traded volume, as in what amount was actually exchanged between market participants, and also, even if it's not actually traded volume, what is the liquidity, as in the amount of tokens that has been placed on order books, as in how much volume do you have on the buy orders, on the kind of how much buy orders do you have for a given token, how much sell orders do you have for a given token, and this is what we call market depth. It's actually, what is the more organic offer and demand on markets representing the native activity for a given token.
And so in this case, let's talk about FTX, because again, we've been reading headlines about this and lots of feature pieces too. What happened with FTT?
So they were valued 8 billion worth of FTT token, and I should have checked the exact numbers, but the actual liquidity, as in organic liquidity on exchanges, was probably somewhere in the hundreds of millions, and probably mostly orchestrated by FTX and Alameda. So there was actually no real organic demand and depth for the FTT token, and that was exemplified when Binance wanted to sell their position, saying they will do it organically on the markets, and FTX knew very well that there was no way that this would actually go through the market organically because there was no organic demand for that. And so that's why they made the offer to do an OTC transaction, and that's kind of how we pulled the rug on all of that.
Well, an XBTO, of course, does a lot of OTC transactions. You have a large trading operation, and not to mention a number of other arms in crypto finance. How have you guys been measuring counterparty risk in this case?
Yeah, we've been doing this for 8 years now. We've taken unsecured loan, we've given unsecured loans, and at the end of the day, you have to protect yourself, right? When you build a portfolio of risk, right? And this is one thing that, for example, you look at Voyager, for example, that goes and lends a huge amount of their assets unsecured. Very little due diligence done. I mean, you really have to look at things in its entirety holistically. When we started trading Bitcoin, and there was no DeFi at the time. It's 2015, 2016. It was all centralized, and we traded on a bunch of exchanges. Started with 5 or so exchanges. What we had decided to do is that there was huge amounts of hacking risks on the exchange. Rug pulls,
something else that you rarely see with the New York Stock Exchange.
Compliance risk, and so you had to basically say, okay, well, what am I willing to lose at any one point, and how much am I going to make in any given year? And back in the day, you could make 100% a year, easy, in crypto. And so losing 20% of your assets is not such a big deal. I mean, you accepted that risk. So lending unsecured, and by the way, when you put money on an exchange, it's unsecured lending, really.
Wait, what do you mean?
When you put money on, I'm not going to name any particular name, but say you put your money on FTX, right? You're effectively lending money to FTX unsecured at 0%. You're taking a massive risk, right? You're hoping that there's going to be a return of principal because there's no return on principal.
We underscore the concept of that essentially the whole not your keys, not your coins thing is really meaningful Because even what we've seen seemingly is that legally, these assets, we also saw this with Celsius, that the assets that were effective deposits on the exchange were in essence loans that became their value.
That's right. They were not legally defined as loans, but effectively they were loans, right? And so you have to know really, in essence, what are you doing? What risk are you taking? What operational risk? What compliance risk? What legal risk? What FX risk? There's so many risks out there.
I mean, it's wild.
It's wild.
So then
you really have to look at it holistically because you can't just look things in silos.
So one of the major concerns I think that we also saw with FTX is that when you were actually even first depositing cash on FTX, it turns out you being a consumer, were actually sending a wire transfer to a bank account in Alameda Research's name. That's a sister company to FTX. And then beyond that, of course, we saw that Sam, seemingly, or allegedly, was taking the not only FTT tokens, but the deposits, Bitcoin deposits and others that were on FTX, the customer deposits, and then rehypothecating those. You are, of course, helping run a custodian. Can you tell us a little bit about why exchanges should use custodians? Let's talk about the positive side first, and then we're going to go into the negatives.
I think it's right. Well, it's counterparty risk management, no? So what we see now after FTX, and I would call it like a kind of a Cambrian event, like there is a before and after FTX. Now we're going to see on the regulatory side, but we also see it on the demand of clients. So now hedge funds, many of them came to us and say, look, we're just going to deposit, all of our funds now back to you as a custodian.
As opposed to what were they doing before?
They were just maybe having 50% of their assets on any given exchange on any given day because they felt comfortable. They thought, okay, nothing can happen. They are well back. They have, I don't know, like $60 billion in the balance sheet, and even without a proof of reserve back then, but they will just, assume that everything's going to be all right. Because they were, as Patrick was well saying, you had certain benefits. You could maybe lend those funds. You could get maybe some kind of type of earn program.
Sure, we saw lots of these exchanges offering yield products.
Exactly. So the point is now what you want to do is minimize as much as possible the risk. And the best solution, or the way we see it, is that we have to split the, what is custody to what is execution. So in Nasdaq, you don't send your money to Nasdaq, right? You have someone that is gonna be your broker, then you have your custodian, and they will execute the order. So we see it the same way. So essentially, we are working, since 2 years and a half on a solution that is called ClearLoop that helps you to just mitigate the risk by you as having a wallet with us, then you can just delegate virtually some of those funds and then initiate a trade in the shape of a margin. So
I want to make sure I understand this a little bit better. So one of the issues that I might think are the negatives about using a third-party custodian is that I wouldn't have access to some of those yield-generating financial products that have been created by exchanges, or perhaps DeFi. Are you telling me that there is some?
No, it's rather just plain execution. No, so
okay.
You want. So for example, you have a limit order, and you're gonna have those funds there for maybe like 3 weeks until that limit order executes. So you want to mitigate that risk. You don't want to send actually money to the exchange. You prefer to have it with the custodian, and when the moment comes, then yes, you can settle post-trade.
So then let me ask you this. Are you actually seeing, not hypothetically, but are you actually seeing exchanges that previously were custodying the funds themselves, are you seeing them already beginning to migrate to using third-party custodians?
Yeah, what we see is essentially the clients demanding these exchanges, we need a solution like that, because otherwise we're not going to we are not going to, exactly. We're not going to change the exchange.
So it's interesting. So it's almost like markets are to some extent self-policing and forcing this type of, I'm going to call it TradFi-esque
100%
split between duties. Okay. Very interesting. Let's talk about some additional risk, Philippe. In terms of markets, with FTX, of course, we've seen so many different types of issues. One of the other market risks, I would say, is that people don't seem to be able to do due diligence. You have a venture arm. You guys have invested in God knows how many companies over the years. What do you look for as a venture investor that perhaps investors in the crowd should be thinking about?
At the end of the day, you can't rely on anyone for due diligence. You are on your own. When you make an investment, whether a Sequoia or GIC or whomever is regarded and revered and has zillions amounts of Twitter followers, at the end of the day, when you make an investment, you have to make your own due diligence. And well, some people are more equipped than others. Some, you know, I mean,
what are
I've
like
been
some of the types of
doing this
questions
for 20
you would
years,
ask?
so I look at things a little bit differently than most. But you know, you develop a sense of what can go wrong. Can I really trust this person? You see things multidimensionally, and you're able to come up with a value that tells you, is this a good risk reward? Everyone has a different way of doing due diligence. You know, it's also like cultural. You know, the West Coast VC type versus the East Coast VC type is very different. The way they look at due diligence. You know, so everyone does due diligence in a different way. Like in crypto, there's this element of trust that shouldn't be there because we're trying to build a trustless system, right? At the end of the day, right? You're trying to build a blockchain. Bitcoin, which is the strongest, most secure blockchain, is effectively trying to disintermediate the middleman. And to the degree that you have the technical know-how and the governance and the ability to be your own custodian, which is, you know, the pendulum swings the other way, right? We're fully centralized, FOMO, let's go, it doesn't matter what this project, how decentralized this project is, or whatever, you know, because the price is going up, because my neighbor's doing it, I must be in it, right? To the other side of, I need my keys, I need to hold my keys personally. But that's a huge risk that only, I think, less than 5% of the world, or it's probably a lot less than that, I'm being very nice, can actually do it over time well, right?
Yeah.
You probably custody your keys for 1 or 2 months, you're not gonna lose your private keys and put it in a safe. So, but custodying your private keys.
Although I will say, I've personally lost some wallets before.
Everyone has
Seems
at
like a rite of
some
passage.
point. It's a rite of passage. You're learning, and you know this very well since you're in the custody business. It is it's a full-time job, 24/7, and it's stressful, especially when you have other people's money. When you have your own money, it's one thing, but you have other people's money.
Yeah.
I mean, it's like, so you know.
So anyway, due diligence is each of them has their own. This is what I want to kind of summarize what you're saying. Yeah. Everyone has their own set of diligence, but one should certainly be looking at governance. They should be understanding the teams.
Last year was all about governance, really. Yeah. It was not really about decentralization. We'd have many hacks on smart contracts. You could lose your money any which way in 2022, right? Terra Luna, you know, is tokenomics gone wild. It's
I was going to ask about that in a moment.
There was no particular bug, but it was prone to be attacked, and it did get attacked. And so, but the problem is real strong governance that's really kind of lacking in this space. The FTX didn't have a board, barely had a CFO. I mean, they're cussing their assets on email. I mean,
that's
what
a little bit wild.
Are we doing?
Well, let's talk about some of the positives too. I want to flip to the other side here because although there are risks, and I think that anyone who heard this panel so far should be shaking in their boots and saying, why am I investing in cryptocurrency whatsoever? Let's talk about the positives for a moment. Ambre, you operate a business that in many ways dives very deep into what's called on-chain data. Can you tell us a little bit about why there's a superiority with digital assets in terms of risk management that is only viable because of the public nature of these blockchains?
Yeah, I think we're going back to the ethos of blockchain, right? It's about trust, it's about transparency, it's about auditability, it's about being able to get back in time and not audit just the situation right now, but how it came to be what it is now. I think that is the power of blockchains. Just maybe, you know, to what Philippe said, between the pendulum of full centralized, kind of you trust someone else to do everything for you, and full decentralized, where I think it's a bit of a utopian dream to think that everybody's going to be in charge and self-custody of their own funds, because if you drill down, nobody wants to take that responsibility. I think where we're going to end up as an industry, and that is a positive, so answering your question, is I think it's going to be a hybrid thing where we are going to leverage decentralized systems for a lot of the operational things today that does not need those centralized points, and that we are still going to rely on some form of centralization for specific services that are important. And I think where blockchain today has proven that it works is from an operational and technology standpoint. Like, that is solved. Blockchain works, right? Blockchain is a great system.
Insofar as, for example, Bitcoin has never, in the history of Bitcoin, failed in terms of taking a transaction from A and eventually it arriving at Z.
Exactly. But I think where we've failed over 2022, and I think the lessons learned from last year getting into 2023, the positive that I see is that we're now reintegrating much more blockchain into CeFi. And so I'm not
Can you explain what you mean by that?
Yeah. So TradFi for me is traditional financial industry, nothing to do with blockchain, nothing to do with crypto. CeFi is traditional financial services applied to crypto. And then DeFi is decentralized financial systems working and leveraging blockchain technology. For some reason, at some point, we've been opposing CeFi and DeFi, and we've been, either you're a DeFi, degen, geek, whatever, doing some crazy, dangerous stuff with your tokens and getting high yields, whatever, or you were putting your money and trusting unregulated or unregulated centralized exchange. Essentially, I agree with Philippe, lending them money at 0% and kind of working with that, which was serving some good aspects of reassurance that you can always sue someone if something goes wrong. But anyway, now what we've seen is that pure CeFi also has flaws, and that we've been reintegrating some blockchain components into CeFi. And an example of that, which is imperfect but still a good one, is proof of reserve. CZ was talking about it on his talk yesterday.
So what is proof of reserve?
It's basically a centralized exchange has customer loans or customer deposits. Let's call it customer deposits. I think it's better. And in the case of FTX did crazy stuff with customer deposits. What Binance is doing and has done, I think they were the first ones to do proof of reserve, is showing on-chain, as in leveraging blockchain as a technology to use that trust and transparency component to prove to the world that they do hold customer deposits in a safe place, in a wallet that they control, etc. So it's really, for me, entering 2023, it's about really bringing back the great things of blockchain into centralized systems and improving the way TradFi/CeFi works, leveraging blockchain. So it's never going to be full DeFi or full decentralized, but there's so many things already from an operational and trust and transparency standpoint that we can leverage integrating some blockchain components into how we operate.
I want to dive a little bit further into proofs of reserve. Philippe, is it sufficient to simply see how much crypto is currently deposited on an exchange's wallets?
I mean, it's a great first step, right? You've got a technology that allows you full transparency into, the ins and outs of a token of value, right? So you know that Bill passed to Adam, 2 Bitcoin, and that those Bitcoins are there, and you can audit them. Everyone can audit them on the blockchain. That's the power of transparency. If you could trust that blockchain, that's immutable, that's secure, then that 2 Bitcoin you can take it to the bank. Now, the problem is the liability side of the equation is kind of obfuscated here. As we've seen in 2022, there's a lot of shadow leverage. There's a lot of...
What do you mean by shadow leverage?
Shadow leverage is basically leverage that on decentralized finance, right? When you lend to Aave, you can see that there's a loan there. It's completely transparent. If I take, for example, FTX again, I take your $100.
It's fair to beat up on FTX.
I take your $100,
yeah,
and you think I have the $100, but I take the $100 and I lend it out, right? You can't really tell whether I'm holding it or I've lent it out, right? And so there's an inherent amount of trust that you have to take into account, especially if there's leverage on the exchange. FTX has massive amounts of leverage because they basically levered everything. Everything was collateral, good collateral. And to your point, we know that it's very hard to designate something that could be a tier 1 considered solid enough collateral value, right? Bitcoin and Ethereum, in my opinion, is probably one Tether maybe, and the stable coins, obviously, to the degree that you trust the sponsors. Other than that, I mean, FTT was extremely centralized, right? It was basically a company issuing some of its script.
So let me, very
saying,
quick
it's
follow-up
got
on
value
that.
because Alameda.
How do we know that something is centralized in the first place in terms of a cryptocurrency? Because it seems that something like Bitcoin, which is so decentralized that the United States considers it a non-security, it's the only one that they are effectively guaranteeing, or they've deigned that to be the case. If I were an investor, how would I even know if cryptocurrency is decentralized?
I would say, I mean, coming back to the point from Ambre and on the data transparency, you can go and see what is the distribution of the wallets and who is holding most of the assets, right? There is a problem, of course, of all the tokenomics and all this vesting period, and who, in the end, after maybe 1 year and a half, who's going to end up holding maybe like 20% or 30% or even 40% of the token.
And depending on how the tokenomics work, or the governance, I should say, of that cryptocurrency, they may have voting power to change the rules. Is that right?
Indeed,
Yeah.
correct. If it is a DAO, for example. And the point is, like, at least how can actually you consider exiting that market, right? What is the market depth? I mean, essentially, there are so many loans out there actually where nobody actually sit and say, okay, well, yeah, I give you a loan, and this is your margin call, and this is the limit where we're going to actually execute you. But I mean, can you really execute that order? What is the market depth if it is a black swan? I mean, can you really actually, recover those assets and at least go, flat? Because probably you're gonna end up with a loss. So that's quite unique to crypto, I would say.
Well, I mean, we certainly have seen with equities, for example, that it's easier. There's enough data out there to support if you're going to do a large block trade of some sort. You can do that without necessarily moving the market. We have some data to support that. Is that true also on chain? Is there a way to measure if I'm going to go and try and I don't know, buy or sell 1,000 Bitcoins, how it's going to go and move the market?
Absolutely. It's called price slippage. It's a very traditional metric that we sell off the shelf, and price slippage essentially means you give us any order size, let's call it 10 Bitcoin, 100 Bitcoin, whatever it is, and we tell you what is the aggregate, like across all exchanges, be it all DeFi together or all centralized exchange. You choose your selection of exchanges, and we tell you what percentage of the public price that you're seeing now is going to be kind of impacted, what is going to be your execution price based on that amount of trade. And that we can give you an aggregate price, but we can tell you basically how, I mean, that's the principle behind smart order routing and kind of breaking down a trade and allocating batches of that trade to exchanges based on the actual liquidity of those exchanges in order to make the minimum impact on your execution price. So this is called price slippage. It's a very traditional data metric that we have. And looking at this, so price slippage is kind of the opposite of market depth. Price slippage is how much will I move the price if I trade 100 million, and market depth is at that price, how much volume do I have on exchanges? And we can give you that at an aggregate level, which is globally today, market depth at 10% of the current price of Bitcoin is X billions. And that is broken down by 600 million on centralized exchanges, 400 on DeFi, and then you can break it down per individual decentralized protocol.
So this helps traders, of course, come to a good decision. Philippe, we only have a couple minutes left. If you had just one bit of advice to give investors out there who are perhaps right now as nervous as ever about participating within this industry, what would you say? What should they do?
If you're very nervous, it's probably a good time to buy.
Very interesting. I love it. Of course, says a veteran over here. What advice would you give investors who are nervous?
I would say do your research, get comfortable with the tools that you have now, and yeah, go with the experts and let them help you to understand the risk and how to mitigate them.
I am certainly convinced on this panel that you do need expertise in this industry. Ambre, what do you think?
I would add everything that they said, plus stick to Bitcoin and Ethereum for now.
Okay, well, you heard it from the experts, folks. Thank you very much. I feel almost reassured after hearing all the fears. Thanks so much.
Thank you.